In this lesson, we will talk about the balance sheet basics, assets, liabilities, and equity. The balance sheet provides a snapshot of a company's financial position by detailing its assets, liabilities, and equity. Understanding the structure and interplay of these components is essential for analyzing financial health, solvency, and operational strength. 1. What is a balance sheet? A balance sheet is a core financial statement that shows what a company owns assets, what it owes liabilities, and the residual interest belonging to its owner's equity at a specific point in time. It is structured around the fundamental accounting equation, assets equals liabilities plus equity. This equation must always balance, ensuring that all resources are accounted for by their sources of financing. The accounting equation, assets equals liabilities plus equity, forms the foundation of the balance sheet. Assets represent the economic resources a company controls. Liabilities are the obligations owed to outsiders, and equity is the residual interest remaining after liabilities are subtracted from assets. This equation ensures that a company's resources' assets are always balanced with the claims against those resources' liabilities and equity, providing a clear snapshot of financial position. Assets on the balance sheet are classified by liquidity, highlighting their ability to provide future economic benefits. Current assets, e.g. cash. Accounts receivable inventory are convertible to cash within a year and valued at cost or market value, whichever is lower. Non-current assets, e.g. property, plant, equipment, intangibles are held for longer periods and valued at historical cost or revalued amounts, IFRS. The order of liquidity flows from cash to intangibles with valuation governed by standards like GAAP or IFRS. Liabilities represent obligations requiring future resource outflows and are classified as current, long-term, or contingent. Current liabilities, e.g. accounts payable, short-term loans are due within a year and affect liquidity. Long-term liabilities, e.g. bonds payable, mortgages are due after a year and influence solvency and capital structure. Contingent liabilities, e.g. lawsuits, warranties are potential obligations disclosed if criteria are met. Together, liabilities indicate a company's financial commitments and risks. Equity reflects the owner's residual interest after liabilities are deducted from assets, consisting of contributed capital, e.g. common stock, APIC, and retained earnings. Common stock represents shareholder investments at par value, while APIC reflects amounts paid above par. Retained earnings are accumulated net income less dividends, growing with profits or shrinking with payouts. Treasury stock reduces equity through share buybacks, and accumulated other comprehensive income tracks unrealized gains, losses, adjusting equity with market changes. The balance sheet must balance due to the principles of double entry accounting, where every transaction affects at least two accounts, ensuring the equation assets equals liabilities plus equity remains intact. An imbalance signals errors in the records, which can lead to inaccurate financial reports or legal risks. This structure provides a transparent view of a company's financial position, supporting informed decisions by investors, creditors, and management. The balance sheet provides a snapshot of a company's financial position structured around the accounting equation, assets equals liabilities plus equity. Assets represent what the company owns, ordered by liquidity, such as cash, inventory, and equipment. Liabilities reflect what the company owes, categorized as current, due within a year, or long-term, due after a year. Equity represents the owner's residual claim after liabilities are subtracted from assets. This equation ensures accuracy and transparency, as every transaction impacts at least two components, maintaining balance. The interplay of these elements reveals critical insights into a company's liquidity, solvency, profitability, and risk. By analyzing the balance sheet, stakeholders can assess financial health, operational efficiency, and funding strategies, making it a vital tool for decision-making. Now, let's practice with a scenario. ABC Corporation is a retail company that recently expanded its operations by opening new stores. To finance this expansion, the company took on a significant amount of long-term debt. However, due to unexpected market conditions, sales have been lower than anticipated, leading to concerns about the company's ability to meet its short-term obligations. The management team is reviewing the balance sheet to assess liquidity and solvency and determine the company's financial health. Multiple choice question 1. What financial metric should ABC Corporation prioritize to assess its ability to meet short-term obligations? A retained earnings, B current ratio, C debt to equity ratio, D net income. The correct answer is B current ratio. Let's explain it briefly. The current ratio measures a company's ability to meet short-term obligations by comparing current assets to current liabilities. It is a key indicator of liquidity. In the next lesson, we will talk about the working capital in SPA definitions. Working capital represents the difference between a company's current assets and current liabilities.